Bismillahirrahmanirrahim. Our today lecture is very important related to accounting equation and major financial decisions. How we can draw the major financial decisions from the accounting equation. This lecture is for a very basic the students who are having their finance subjects at first time, and it will help you students to understand how we can extract the data from the accounting equation while making the major financial decisions. There are two things, one is accounting, second one is finance. What is difference between accounting and finance? Accounting is all about record keeping, and deals with finance deals with decision making. And for concrete decision making, we are required some data, and data can be extracted from the accounting side. So accounting side is input. While utilizing the data from accounting, then we can go for the major financial decisions. And accounting equation, as we know that assets are equal to liabilities plus owners equity. So left side there are assets, and right side of the equation there are two components. One is liability and second one is owners equity. The combination of these two components, liability and owner equity, equates the assets. So as we know, there are two types of assets: fixed assets and current assets. Here, fixed assets. What are the fixed assets? Fixed assets are called real assets, and which are physically existing and functioning are called the fixed assets. And current assets, these are the working capital of the firm, like cash, inventory, account receivable. As we know, liability is also divided in two categories. One is short-term liability and second one is long-term liabilities. Okay, and I start my lecture taking an example. If you want to acquire a real asset, it means you are going for long-term investment. Real asset means they are long-term investment, they are fixed assets. And fixed asset, if you want to acquire any fixed asset, it means we are going for long-term investment. Long-term investment in finance language is called capital budgeting. Long-term investment in finance language is called capital budgeting. And capital budgeting, there are several techniques while selecting the most appropriate project. There are discounting techniques and non-discounting techniques, like NPV, net present value, IRR, internal rate of return, payback period, discounted payback period, profitability index, average accounting return. These are the widely used techniques while making the investment decision. While you are going for selecting a project, if you are having more than one options, and which project can provide you the better results, will be favorable, these techniques can be used. And it's preferred the technique which is having the time value of money, means that there should be some discount rate of a rate of return to manage the risk, and there should be value addition. That techniques is preferred. So I started my lecture. If you want to go for long-term investment, if you want to acquire a real asset, it means you are going for long-term investment, and in finance language, long-term investment is called capital budgeting. Here you want to acquire a real asset, it means to meet the obligation or to meet the requirements to acquire a real assets, we require funds. So funds can be generated from the right side of the equation. in right side of the equation, one is liability and second one is owner's equity. As I have stated that liabilities are divided into two categories, short-term liabilities and long-term liabilities. So we are going for long-term investments. Obviously, we will be taking the help from long-term liabilities. If we look at the long-term liabilities, long-term debt, there are long-term debt. There are two kinds of long-term debt. One is non-tradable. Second one is tradable. If we look at non-tradable, it means they are the bank loans, syndicate loans. Why we are going for long-term debt? Obviously, if you want to acquire an asset to meet the obligation of your long-term investment, to meet the requirement of your long-term investment, we require fund, and for fundraising we have two sources. One is debt, one is equity. If I talk about debt and it's non-tradable, obviously you are talking about bank loans. You're talking about bank loans. And what is syndicate loan? It's a consortium between different banks to fulfill the requirement of long-term investment of any firm or if for any project. So non-tradable, when firm go for bank loans, it means that is non-tradable. If go for the tradable debt, what is tradable debt? These are the bonds, and bonds, there are two components with bonds. One is coupon rate, second one is face value. What is face value? Face value is the price written on the bond, which remain fixed over the life of bond. And coupon rate, the price of bond will remain fixed. That is called non-arguable because it's fixed. It's fixed. There is no room for argument. So we name it non-arguable. And there are two types of bonds. One is government bond, second one is corporate bond. Government bond, they are secured bond. They are secured bond. So it means they are having low risk. If there is low risk, there will be low profit. So secured bond, these can be T-bills, T-notes from the government, issued by the government. If government wants to raise funds, they can issue the bonds. They are secured bond. So corporate bond, they are unsecured bond. With corporate bond, there is coupon and face value, and they are fixed, and they are unsecured, and if they are unsecured, they can be redeemable or it can be irredeemable. So I will simply discuss that funds can be raised either from the non-tradable or tradable. Why we are going for raising the fund? To meet the requirement of long-term investment. Then there is a valuation of bonds. This is another point, and how while we're talking about the valuation of bond, we normally focus on the fair price or pricing or valuation, same things. We can discuss the duration, we can discuss the yield to maturity, and we can talk about the convexity, how the bond is sensitive to change in the interest rate. Okay, this was the long-term debt side. If we raise the funds to meet the requirement from debt, and the second option is owner's equity. If we talk about the owner's equity, these are the stocks and shares. So when we are talking about stocks and shares, there are two components. One is dividend, second one is market price. So market price, it's changeable and it's not fixed. So we can say dividend, it also depends the policy of firm or the situation of firm. Either a firm pays the dividend or not pay. So they are not fixed. Then we can say they are arguable. These are arguable. And if we are talking about the dividend, there are two major school of thoughts. One is irrelevant school of thought. Second one is relevant school of thought. If we look at the irrelevant school of thought, it means Modigliani and Miller, they proposed that dividend is not related with the value of firm, is not related with the value of firm, and but their model are based on the unrealistic assumptions, and these assumptions might are like non-taxable, then perfect competition in the market, and many other assumptions. These are unrealistic assumptions. Then they proved the dividend is irrelevant, either from pay or not pay as the dividend, then there will be no effect on the value of firm. There is another school of thought that is relevant school of thought. There are different proprietors like Gordon, Walter, Lenter. They are in the sport of relevant school of thought. They stated that dividend does affect the value of company, value of firm. If we are going for talking about stock or equity, then we can check the valuation, we can calculate the valuation of stock, and it's non-arguable. There are several models to calculate, to check the value, to find the fair price of stock, and these models can be relative models, these can be cash based models, dividend based models, value based model. Every model has its own characteristic assumptions, and their values can vary from each other. That's why we name them arguable. And relative model, it is having a lot of submodels, and we can use any of the model while making the decision, and either the stock market price is overpriced or underpriced in the market, either stock is traded overpriced or undervalued or overvalued, then the effective decision can be made. So uh, to meet the requirement of long-term investment, we are we have the right side of the equation, and right side of the equation, accounting equation, is the financing side. Either the financing can be made from debt side, either finance can be raised from the equity side, or either it can be the mixture of debt and equity. And if it's the mixture of debt and equity, then we can say we are talking about the capital structure. So what is capital structure? Capital structure is the mixture of debt and equity, or either it can be debt, either it can be equity. And why the capital structure is made? To meet the requirement of capital budgeting, capital structure is there. And while we are talking about the capital structure, so obviously when from issue the bond, there is cost is associated. So bond is, this is the debt side, so that is the cost of debt. If equity, there is also cost is associated, and that is called cost of equity. And if there is a combination of debt and equity, then we can find the cost, weighted average cost of capital, and here we can find the optimal capital structure level. There are a lot of approaches. While we are talking about this capital structure, then we can go in detail. So till now, if we look at the current assets are the working capital, that can be cash, inventory, account receivable. So the major financial decisions which I have discussed, one is capital budgeting, second one is capital structure, third is dividend policy, and fourth is working capital. Working capital deals with daily financial decisions, and daily financial decisions, it's very important how much firm has the cash, and how much will be the inventory, and these decisions are very important. And net working capital, if we talk about net working capital, so it's the difference between current assets and current liabilities. While talking about working capital, there are several chapters: cash management, liquidity management, inventory management, credit management. Here are also several chapters. While we are talking about capital budgeting, capital structure, several chapters, cost of capital, several chapters are there, valuation, then dividend. So these are the overall trees of major financial decisions. So there are if we talk about, if we look at the different types of firms, there are three types of firms. One is growing firm, declining firm, and normal firm. In declining firm or growing, if we talk about growing firm, the dividend payout ratio is low. The net income of any firm is divided into two parts. One is dividend, second one is retained earning. Here, firm is growing every year. It's growing. The revenues or income is increasing every year. It's growing fast. So, what is the point of view of investor? Investor point of view is profit maximization. Profit maximization, and already the firm is in growing every year. It's growing. So obviously, to take his money out from the growing firm, and obviously as he or she is having the excessive money and will go for the another investment opportunity, and he or she is not confirmed either he or she can generate the good profit or not. So it will be preferred in growing firm, the dividend will be less paid and will be the more retained, and retained earning is also used to meet the obligation of working capital. If they are having the excessive amount, then that can be also supported to long-term investment. After meeting the requirement of working capital, the remaining amount, the finance manager can make decision, or chief financial officer can make decision how much the retained earning part can be used to meet or to support the long term investment. So in this case, if firm is in growing firm, that will be low, will be the ratio, paid out ratio. If it's declining firm, then the high payout ratio, it's high payout ratio of dividend, because today cash is better than some future risky cash flows. So the dividend payout will be more. And if I talk about the investor point of view, because that is liability of the firm, and the firm will there will be high payout ratio. Normal firm, it's indifferent, and it behaves as per the market situation. Indifferent payout ratio or reinvest, they are these firms are indifferent. So these are the types of firm, and in which firm payout ratio is high, in which firm payout ratio is low. Then who takes the major financial decisions? Obviously, the chief financial officer or managers are the or take the major financial decisions. So there are three types of managers: aggressive manager, they are risk taker; hedge manager, respond according to the situation; third is conservative manager, risk avoider. As we know, higher the risk, higher the return. If liquidity is high, it means they are having more excessive cash or cash equivalent assets. Liquidity high. Working capital, it means they are having the high amount of cash or equivalent asset. Then they 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 lost the opportunity of investment because they are keeping a lot of money, and most of the retained earning part they kept here. They kept here. They didn't support the long-term investment from their retained earning. And retained earning is internal source of financing. If there is internal source of financing, it's less costly as compared to external. What are the external source of financing? Debt and equity. If you support your asset from the internal source of financing, then the cost will be low. If cost is low, profit will be high. In this case, if liquidity is high, it means that firm is the manager is making decision to keep the high amount of cash or equivalent assets. So obviously, the less amount will be remaining to support the long-term investment. So profit will be less. Then because it's having high liquidity, obviously risk will be low. So it's proved. High liquidity means they are having the liquid assets high, then there will be less risk. Default risk or liquidity risk will be low. If risk is low, profit will be low. So this is the approach of conservative manager. Conservative manager, risk avoider. He is not risk taker. So obviously he will keep the more working capital, cash or equivalent assets. If another manager, like aggressive manager, risk taker, if he is risk taker, he will keep the less amount of cash or equivalent assets, then the major part of the retained earning will be invested to meet the requirement of long-term investment. Obviously, low liquidity, risk is high, then profit will be high because uh, the aggressive manager has supported the long-term investment from their retained earning. One is temporary, and second one is permanent working capital. Temporary working capital and permanent working capital. Anyways, this was the very basic lecture for all students, how we can extract the major financial decisions from the accounting equation. And uh, uh, and these financial decisions will be discussed in detail while